And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. Very few financial writers have had the impact Charlie Ellis has had. His 1975 book, Winning the Loser's Game, popularized passive or index investing 50 years ago. Charlie Ellis joins us now, along with ETF expert and financial futurist Dave Noddick. Charlie, thanks for being with us. You've got a new book out this week, Rethinking Investing. I read it. It summarizes your investing philosophy. You've been a champion of index investing and staying with the markets, not trying to beat the markets for 50 years. Here's a copy of the book we're showing right here. You were a very early champion of ETFs. This show is about ETFs, so let me start with that. What do you like about what you see in the ETF world right now, and is there anything that worries you about ETFs?
Sure. What you've got to be really positive about is a terrific increase in the variety of ETFs that are available and a reduction, steady reduction in the fees that are being charged. That's all good news. What you've got to be worried about is some of the ETFs that are being produced are much more for the salesperson than for the buyer. And they're too specialized, too narrow, or the ones that really bother me are the ones that are highly leveraged so that you get explosive on the upside, but also explosive on the downside. So you've got to be careful. ETFs are an absolutely wonderful device, and very, very effective. I use them, and everybody I know who's really with it with regard to investing uses ETFs, but you've got to be careful enough to use the ones that are appropriate for who you are and what you're trying to accomplish.
Yeah, good point there. I want people to understand your place in history here. You, along with, I guess, Burton Malkiel, who wrote A Random Walk Down Wall Street, and the Vanguard's founder, Jack Bogle, three of you were sort of the intellectual architects of index investing. 50 years ago, you were talking about this. That approach, indexing, has clearly won out. But now we see the active investing community sort of reacting, some of them claiming passive ownership or indexing is approaching dangerous levels. Is there any truth to that? Does that concern you at all, or is that just sour grapes by active management?
I think it's sour grapes primarily. It certainly doesn't bother me at all. When people talk about peak passive and other ways of describing, there are too damn many people going into passive investing, so it's got to be really wrong. They forget that the only thing that really matters is if you drive the really good active investors out of the business, then maybe you've got a problem, because passive has got to be dependent on active managers who are really good. But candidly, the number of people that get hired into active management keeps rising, and we're way, way overloaded with talent in that area. And we're going to stay there as long as it's great fun, high paid, and you might also make a small fortune on your own account while you're in there actively doing something for other investors. So this nonsense about peak passive, is candidly just nowhere near on the money. The real problem will only be when people stop being active managers, and that's a long, long, long way off.
Dave, you've written a lot about this. Peak passive, there's still plenty of active managers
I think
out
there's
there.
still plenty of active managers around. I understand Charlie's point here. I do think that there are places in the ecosystem where the prevalence of passive flow really does have an impact. If you look at things like just derivatives trading, you look at the amount of money indexed against the same 500 securities all around the world in swaps, derivatives, futures, you name it. That does have impacts mostly on the plumbing of how markets work day to day. And let's remember also that almost all the new money coming into the market is coming into passive funds. And because of that, there is this sense that we're constantly bidding up the same securities in the same proportions. That leads to momentum effects. Yeah. Do I think it's destroyed price discovery? Absolutely not. You can look at any given day and see the enormous divergence between the best and worst performing stock in the S&P 500 to realize that price discovery is still happening.
Yeah. So the argument here is, I'm paraphrasing the ETF haters, the argument is passive investing essentially has been driving up growth stocks, and it's shrinking the pool of price-conscious investors out there. And value investors bitterly complain that they don't have enough firepower anymore. But is there any merit to any of these arguments?
There is some truth to that, but also it has to be put. Go ahead, Charlie.
I would say there is a little bit of merit to each of the different points that's been made. But if anybody tried to measure it, and you know darn well that every PhD candidate across the world is trying to find a way to outsmart the idea of passive or indexing. And the same thing is true with ETFs. They're searching and searching and searching for something that they could report, because if you're a PhD candidate, that would be gangbusters. They're not able to find it. We can talk about it must be there, and I will agree that it must be there, but the magnitude is so darn small that nobody's been able to measure it and say, Eureka, I've found it. Look, here it is. It's not there.
Yeah.
I certainly don't think that there's any evidence that we're all of a sudden going to end up in a world where people are beating the market on the regular, right? I mean, I think the math here, which, hey, I learned from reading Charlie's books, right? The math here is inexorable, that it's really impossible to beat the market consistently. I mean, Charlie in his own book, in the recent book, points out that, hey, active management outperformance is possible. You'll just never find it in advance, and that's the problem.
Yeah. So the corollary is passive inflows continue. Equity valuations might continue to climb sharply because it's just...
Sure,
but as you point out, there's no evidence
we also just had the best year for active management inflows in the ETF market we've ever had.
Yeah.
So it's not that nobody thinks active management should exist or it should exist in the ETF wrapper. It's just the vast majority of new flows because they're coming in from fairly unsophisticated individual investors go into big indexes and big target date funds.
Charlie, I want to get back to the fundamentals here for people who aren't familiar with your history here. Your new book emphasizes the keys to long-term investing success, and they are saving, first off, the power of compounding interest, and using index funds and ETFs to minimize fees. This is sort of like Charlie 101 here, and you've devoted decades to studying this whole thing, active versus passive or index investing, whatever you want to call it. One of the things that you will bring up regularly is S&P's annual SPIVA study, which shows over 10 years, 90% of large cap fund managers underperform the S&P 500, 90%. So can you just, for people who aren't familiar with your work, because your work is seminal in understanding this, summarize why active managers almost invariably underperform their benchmarks for us?
Well, the ironic but true answer is they're all so damn good at what they're trying to do that they cancel each other out. They all have fabulous computing power. They all have access to Mike Bloomberg's terminals. They all have terrific models, quantitative models that they can follow. They have access to the most extraordinary amounts of research information available worldwide, and they've got terrific striving focus as individuals. They're really terrific people. They are very good at what they do. The only problem is everybody else knows exactly what they know as soon as they know it, and everybody else is smart as the dickens, and they're all competing. And it's a little bit like playing poker with all the cards face up on the table and then betting for real money. It's really hard. And the problem they have is there are some modest costs of execution and operation, and that's what's showing up.
Right. So the point is, this isn't because, Charlie's point is not because active managers are stupid or dumb, it's just the opposite.
Right.
Most are now professionals and they're really smart, but they're all just competing against each other. It's a simple insight, but it's very profound.
And Charlie's got a great section in the new book on this where he talks about how technology, far from being a competitive advantage for this firm or that firm, has actually been this unbelievable equalizer across active managers. So where once you might have had a better model, a faster computer, a better connection to the market, now everybody's got that. So if everybody's got all the information, to Charlie's point, getting an edge is extremely difficult.
Right.
And the idea you as an individual investor are going to get access to that manager with that edge, vanishingly small.
And so why is active management still so prevalent?
Give me just a minute to say something.
Go ahead.
That's very helpful. You know, at my advanced age, I'm 87. So what the hell am I doing paying attention to investment management these days? Because I was around in the 60s. Then in the 60s, you could call any corporate executive and say, I've done my homework. I'd like to come and meet with you. They'd usually invite you to stay for lunch. Then you get an hour of in-depth information from the corporate executive, trying to be sure that their stock price was fair or as high as it should be, as the best protection they had against corporate raiders. Today, that kind of a conversation is against the law. Nobody does that anymore.
Yeah.
It's illegal.
Reg FD. Yeah.
Yeah, and arguably should be, but it is a leveling of the playing field that makes outperformance incredibly difficult.
Yeah. So the question people ask me all the time is, well, all right, if they always underperform, why do so many still use active managers? And you have what I guess you would call it a recency bias. Those who outperform get the publicity. The financial press does this. We highlight whoever the hot active manager is and make them stars.
Yeah, we're always chasing the hot dot. But again, another great part on behavioral finance in his book, Charlie talks about the fact that, look, everybody thinks they're above average, right? Everybody thinks they're in the top 1%, and therefore they'll be the one that will be able to pick that active manager who will outperform. It's very hard to convince people that they have to accept the average.
I want to talk about fees, Charlie, because you did a lot of work in this 50 years ago, and we note this all the time. It's sort of conventional wisdom, but a lot of people think, well, look, what's a 1% fee or a 2% fee if the market goes up 10% every year? But as you point out, those fees dramatically eat away at long-term returns. So here we have a chart of returns on a $100,000 investment. This is from your book, 6.5% annual return, and you have look at this, 1% fee over 20 years. The return is $300,000. But if the fee is 2%, your return is $250,000. And if you're paying a 3% fee, your return is only $200,000. This is a very simple way to understand how 1% compounding over many, many years. This is a lesson in compounding, makes a huge amount of difference here. And there are various ways to do this. I'm taking this right out of your book, Charlie. But again, I think people have a much better understanding that, yeah, actually 1% does make a difference, or even 0.5%, when you're dealing with decades, when you're dealing with a long period of time. Fortunately, fees have come down, Charlie. I mean, remember, back in the 60s, it wasn't unusual to see 2% mutual fund fees, right? Now you can get a S&P 500 for 3 basis points. Typical ETF fees are below 30 basis points. 25. Yeah, 25 or so. So it's a huge difference. One of your main theses, I'm going on here, I'm hitting Charlie 101 here, has been to stay invested and don't try to time the markets. Now, you had a chart in their book, I'm going to reproduce this right here, that looked at 10,000 trading days between 1980 and 2016. I like the round number here, 10,000 trading days. U.S. equities returned 11.4% in those 10,000 days. That's 1980 to 2016. But if you were not in the market on the 10 best days, just the 10 best days out of 10,000, your return instead of 11.4% would be 9.2%. And if you were out of the market the 20 best days, the return was lower to 7.7%, and if you took the 30 best days, you were out of those days, you're 6.4%. The obvious point being here is you have no idea when these best days might occur. Therefore, market timing, you think you can go in and out and choose those best days, doesn't work.
And the math doesn't work the other way, by the way. If you avoid the worst days, it doesn't make it.
One clue on the best days, they usually follow after the worst days.
Yeah, yeah. But the point here, but if you're not in the market on the worst days, you do have.
Yeah, the counter to that chart, I put that chart up on slides before too. Some people will say, yeah, but you're out of the bad days. There are more good days than bad days. That's why markets go up over the long term. I mean, that sounds really silly to say out loud, but if you're missing the 10 best days in the market and you miss the worst 10 days in the market, you're still much worse off than if you just stayed invested. The math on that's pretty hard to argue with.
I'm staying with Charlie 101 here. We're going to go right through the key points, but several chapters in your book discuss behavioral economic biases. Did you want to say something, Charlie?
I'd just like to emphasize, at my advanced age, I've been around for a long, long time. I put down everything I thought was important for someone else to know, and it took only 100 pages. And anybody can sit down and read through 100 pages. That's why I think the book, which I call Rethinking Investing, has a real offer to many, many people.
Okay. So I want to go back to this point here. Again, we're doing Charlie 101 here. Several chapters talk about behavioral economic biases. And those of you who aren't familiar with this, these are biases that literally infect your thinking and throws off the way that you look at things. And it's a problem for the overall market. Now, you list several different kinds of behavioral biases in the book here. Let me summarize a couple of them here. Overconfidence, which is probably the most common one. We sometimes call the gambler's fallacy. Belief that because we're right picking a stock, for example, we'll be right picking all other stocks. Overconfidence. Jumping to conclusions, where you act on only partial knowledge, so you allow whatever your first piece of information you have to dominate. Confirmation bias is another classic one. You only seek information that confirms your pre-existing beliefs. You don't look out for other comments that might contradict what you're thinking. Herd mentality, where you're blindly following the actions of other groups, very typical as well. There's what's called a framing effect, and again, this is all in Charlie's book. The way outcomes are described affects the judgment. So, for example, you could say, people react differently when they say, you have a 90% survival rate versus a 10% mortality rate. Even though that's virtually the same thing, people react differently when you frame it differently. Then there's the availability bias of being influenced by easy to see information, whether it's on TV or not, or tips from TV commentators or commercial, and that's all you do. You just use that. Let me go through one or two more. There is anchoring, which we talked about before, first piece of information, and hindsight, the belief that you predicted an event after it occurred. Finally, and I'm going through a lot of these here, but there's a sunk cost one. You're investing in a failing investment. You don't want to take yourself out of that. And this is related to loss aversion, that the fear of a loss is much greater than the expectation of a gain. So people tend to hang on to their losers a lot longer than letting their winners ride. And then there's an endowment effect, assigning a higher value. I own this stock, I own this coin, whatever, therefore I think it's worth more than it actually is. There's a lot of them in here, but you know, this is one of the reasons, Dave, stock prognosticators are so terrible. These biases literally infect them. We do dozens of them. They infect your brain, and they throw off your ability to make accurate forecasts.
Absolutely, and that's why I love the example Charlie uses in the book of, like, nobody actually wants to be on an interesting airplane flight, and you don't want to be in an interesting investment for the same reasons. Indexing works because it's boring, and it helps you overcome an enormous number of these biases simply because you'll pay less attention to it. The quote I have down here is, benign neglect has worked great for index investors. And I think that's the quote of the book.
Yeah, absolutely. So go ahead, Charlie.
But most of the time, if you go back 50 years ago, everybody really focused on trying to beat the market. Now, if you look at the reality, it's virtually impossible to beat the market. So what could you do? And the answer is work away, attacking the other direction. Instead of trying to get more, try to pay less. And that's why ETFs, as you pointed out over and over and over again, have made such great sense. And then avoiding behavioral economics and the penalties. Bob, if you look at the data over time, everybody who studies it comes up with about the same answer. It costs the average investor 2% a year to make the kinds of mistakes we all make. It's not some other guy that makes them. We all make these mistakes. Then we make them in an unrelenting focus. So when you look at it, in all fairness, that if you could avoid the cost of high fees and you could avoid the cost of behavioral economics mistakes, you'd really be well off. And that's where you come back to your point about benign neglect is such a good thing to have going in investing. And the great thing about indexing and ETFs is, as you pointed out, they're boring, so we leave them alone, and they do work out over the long run very, very handsomely in a way that we all ought to be really looking for.
Right.
And if you don't mind, I'll drop in one last thought. That is, most of us say long term is 6 months and 10 days. That's what the tax man says. That's not us. We start investing in our 20s. We're still investing in our 80s. That's 60 years. How many of us actually think about and put to good use that long-term reality? It's a terrific opportunity for all of us to rethink our investing.
Yeah, that's a great point. But people, there's a couple chapters in my book about this, citing Charlie too, about why people are so bad at predicting the future. And it's astonishing. If you're a stocks reporter, I've been 35 years at CNBC, and the first thing you'll notice, even after 5 years, is everybody's terrible at predicting the future. The individual investors are terrible. Professional investors are terrible. The Federal Reserve has a terrible track record
But
of
there's a very
predicting
good
anything.
reason. It's because we're people, right? All the things that are going to happen in the future are happening because of people. So people trying to predict people always works out terrible.
Well, but the point is that there's a couple of reasons why it's so bad. As Charlie points out, or the research points out, the behavioral biases infect your thinking, number
100%.
one. And number two, the inputs that go into predicting the future are really very big. I always take the example of a Caterpillar analyst. His job is to predict where Caterpillar's price is going to be in earnings 1 year from now. You think, how hard could that be? It's one company. It turns out there's millions of variables that go into determining that,
and then you
including
end up with a
the health of the CEO or the macroeconomic
Right.
picture. So the complexity of the global environment combined with these biases makes it really, really difficult to predict what the future is. That's why staying investing is sort of the logical alternative. I want to move on. I'm still on Charlie 101, folks. One of the things Charlie talks about is what he calls the total financial portfolio, which is a way of looking at your total net worth, not just, what's my 60-40 stock bonds and my 401k. And Charlie, your point is that when you look at assets, total assets, things like Social Security, for example, Social Security should be considered a bond-like investment. Essentially, it's a inflation-protected annuity, and an average investor, your point has been, should be able to tolerate a higher level of stock ownership. Can you sort of explain that when we talk about total financial portfolio that includes everything like bonds, home equity, Social Security, other assets?
Yeah, I just think all of us make the mistake of looking at stocks and bonds and cash and saying that's my portfolio, and then what's the mix? And I think it would be really helpful if everybody would take a look at the present value of that wonderful stream of future incomes that are going to come from Social Security. For most people, that's a very substantial asset. We don't talk about it, we don't measure it, we don't quantify it, but it's a substantial asset. Now, be very surprised if you don't have something on the order of $250,000 to $350,000 coming your way through the Social Security program. And then if you look at the home, that each of us said, I'm not going to sell my home. I agree with you. But your children or grandchildren or great-grandchildren will decide they want to live in a different neighborhood, then they will sell the house. So it's got an economic value. Why not recognize it when you're thinking about what is it that you're dealing with? And if you blend those two, and if you want to add in collectibles, or if you happen to have art on the wall that's really terrific, or if you have wealthy parents that are going to give you an inheritance into the future, any of those things that you really know are valued, why not include them in your thinking so that you won't overweight yourself in fixed income? And the other side, if you don't mind my adding on, is almost anybody looking at the reason for holding bonds talks about the desire to reduce the fluctuations. Well, you can reduce the fluctuations another way around. The way in which major universities have all developed a spending rule that draws on their endowment a certain percentage every year, and they then average that over 10 years or 20 years, whatever length of time you want. I would personally go for 10 years as being plenty. What was the price on your birthday for 10 straight years? What was the price on your wedding anniversary for 10 straight years? What was the price 4th of July for 10 straight years? I don't care what date you choose, but really care about getting a spread over a decade and then use that as your base. You don't give a damn about the fact that the stock market goes up and down, because the flow going into your spending will be so much more reliable.
Right. So his point about Social Security makes a lot of
100%.
sense to me.
And
people say I have too much risk. I can't have 60% of my 401k in stocks. And yet when you look at your total portfolio, as he is saying, and you consider Social Security as a bond-like investment, actually you could tolerate much more stocks.
Well, what we just did was make the case for financial advisors, to be honest, because a good financial advisor does exactly this. They sit down with a client and they say, okay, great, here's your portfolio. Let's talk about your house, your job, your career, your kids. All of those things have to fit in when you're deciding how much risk you're going to take with a given part of your wealth in the market. So whether you're doing that on your own, in which case you need Charlie's advice here to really go through and build your own household portfolio, your total net worth, or you work with a financial advisor who will help you figure that out.
Yeah, important thing here. Charlie, what about other assets out there? How about gold and Bitcoin? Are they parts of, you can see the Bitcoin industry trying to convince the average investor that cryptocurrency should be an asset class by itself. How do you look at something like that?
Bob, I've always thought it was a very good idea that Warren Buffett shared, which he didn't like to invest in anything he didn't think he understood. I don't think I understand Bitcoin. And so I've just accepted the fact that that's not me, and I don't know how to do that sort of thing, so I'm not going to.
Right. And gold? I mean, I've been covering gold for 25 years now. A lot of people argue it should be 3 to 5% of your portfolio. Gold was money. Gold does have, certainly make an argument gold's been around a lot longer. It does have some aspect as a store of value. It has been money in the past. Any thoughts on that?
Yeah, again, I don't think I understand gold and gold pricing, but the things that I have learned lead me to believe gold is not an investment because it doesn't produce increasing value. It's a speculation on what other people are going to decide they think gold is worth in the future.
Yeah.
And candidly, that's not the way I'd like to invest.
It's the same thing with my rock posters. I mean, Dave, you know, I collect old 60s rock posters. You know, Hendrix at the Fillmore. What do? They just sit on a wall.
They're a hedge on the collapse of the dollar.
They do nothing. They don't throw off any money, right. But they do look nice.
Yeah, exactly. And they go up when the dollar goes down.
Charlie, it's been wonderful seeing you again. And I don't know if you're going to produce more books. You produce dozens of them. But it's
honest goodness, I think Rethinking Investing says it all, and for me that's probably the last book, but I've had such a nice time being with you. Thanks very, very much.
Well, it was a pleasure meeting you, Charlie. Thanks.
We really enjoyed it, Charlie. Thanks, and thanks for all the years of advice. You've been a big influence on all of us. That does it for this week's ETF Edge. You just saw one of the great investing legends. My thanks to Charlie and to Dave as well. Now, I've asked Dave to stick around and give us his perspective on broader ETF trends for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows. They're all on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.